Before we get started, a quick disclaimer is that this content is sponsored by Neos Investments, which is for educational and informational purposes only and not financial advice. Investors, welcome a very special guest, Mr. Thomas Bell from Live Off of Dividends and Options Now on YouTube, also known as The Coach, where we're going to be deep diving into his investing strategy, high dividend investing, cover calls, options, and everything in between. He is a very successful investor and knows so much about everything from dividends, options, and everything in between once again. So I'm going to throw it back to you, Thomas, on how you're feeling about just being on the channel right now and the success you've had on your channel and your investing journey.
Absolutely. It's great to be on. Thanks for having me on. Investing right now, especially trading, is the main source of income right now, actually more so than the job. Started out dividend investing. That's really what I started covering on here as far as content. And then really just discovered that, hey, a lot of these fund companies, they issue leveraged ETFs that actually are better in a lot of ways in terms of premium you can harvest through dividends and options. That's a lot of what I've been doing.
Just like how you got started with investing and like what exactly is your investing strategy?
So I've worked in the industry pretty much my whole career. I worked at Chase, for several years, going up until COVID. And then I started wanting to look into, other things, didn't want to work in the corporate world forever. I'm sure a lot of us can relate to that, especially a lot of the viewers, because that's actually how I found finance YouTube. I started watching Graham Stephan, Jeremy, Kevin, and all those guys. They're onto something, like there's this YouTube finance community, and then it inspired me. And with what I knew, because I've studied the subject at two different levels, I've studied it for undergrad and for my master's degree. And so I'm like, I think I can try to do a channel too. I think that financial education is something that really lacks in our society. And so if there's any way I can have some impact on the world, this is the way.
What is your portfolio value looking like right now? And how much do you earn on dividends if that's a big part of your portfolio?
Oh, should I share that? Well, I put it in the thumbnails, I guess. So it's not I guess it's an open secret. The investment portfolio right now, and everything's at Fidelity, it's about 1.2 million. And it's grown significantly this year. So that comes from, it's a rolled over 401k, it's a brokerage account, and a Roth IRA and an HSA. So there's like 5 accounts combined. I used to have half of it at Schwab, half of it at Fidelity, but I was looking to start a business. So I rolled over my 401k from Empower Retirement formed a C Corp and then moved it over to Fidelity. So I've been trading options on the 401k. The 401k was worth about 480 when I rolled it over. I've grown it to like 660 or so, in 3 months.
And so how did you start investing? Like, did you have long-term ETFs? Was it individual stocks? And how has that evolved from when you first started to now?
So actually, my first stock I ever bought was Meta when it used to be called Facebook. First stock ever, it was their IPO. It was down at first like 50%. And then, of course, it came back, sold it for 120% gain. Wish I had held on to it, of course. But like most stocks that I sell, I wish I held forever. But yeah, it started out as a growth investor. And then I started discovering dividends on stocks like AT&T, Verizon, Philip Morris. And then they were like, 4 to 6%. And then discovered like, REITs, BDCs, commercial real estate assets, stuff like that. And then as time went on, more higher yield products started coming out, like Yield Max, Roundhill, Rec Shares, all the usual suspects that we cover on our channels. Before Yield Max, I was doing like the JEPQs and the QYLDs. They were paying like 14%. And at the time, this was only 3 or 4 years ago, I thought those returns were astonishing.
Can you give me a rundown of like what your investing portfolio looks like right now? What kind of strategies you're implementing right now?
I've cut way back on dividend investing, and I've pretty much gone all in on options investing. I call it, well, some people say, it's not the wheel strategy. So I call it coach's wheel because it's my own aggregation or interpretation of the strategy. It's mainly cash secured puts, nothing fancy. A lot of times I'm not even paying that close of attention to the Greeks. Mainly look at underlying companies like NVIDIA, SMCI, Strategy, and companies like that. And the main concern I have is making sure that they're cash flow positive. So as long as they're cash flow positive, I'm comfortable making the trades. The companies continue to go up in a bull market. With the put strategy, you take in so much premium, at least the way I do it, I take in so much premium that I end up buying, if I get assigned, I end up buying the underlying security at such a low price. It's very easy to make a gain and then sell covered calls on top of it.
Why not just buy like a Misty or a NVDY or like Round Hills, like WPay or like any of those funds that kind of do the cover calls and give you income for yourself versus you doing it all on your own?
I'm hands-on. I like doing it myself. I'll even look at, like, I'll go into Ulti's trades and look at some of what they do and get inspiration from that. And part of it, it's because, when you do it yourself, don't tell any of the fund managers this, of course, but, you're not paying that expense ratio, which is not a big deal. But the reason why, and I like WPay. I like WPay a lot. But the reason why I'm not buying more Misty or NVDY, the NAV erosion aspect is what really has me kind of concerned. So I hold what I bought originally, but I'm not really pairing up my positions. And the wheel strategy has been so successful that that's pretty much 90% of what I've been doing over the past 6 months.
In terms of YieldMax, I've seen that you've interviewed Michael Coe,
Yeah.
Jay Pestricelli. We've also been at an event for
Yep.
YieldMax together. Their products have been seeing a lot of NAV erosion, and a lot of investors are becoming concerned about maybe Misty, Ulti, YMAX in general, just their whole lineup. So what are your thoughts on YieldMax and even just like the current state of how they've been performing for investors?
Well, I have an analogy, between YieldMax and all the companies. It's like anytime a major like invention gets released, and it's like you'll have 6 or 7 different people or entities all kind of working on it at the same time, and eventually one of them perfects it. And then they're the ones that gets credit, like Edison with the light bulb. They're the ones that like gets credit for it. But I think that it's getting better. So I think YieldMax, their newer strategies of going weekly, which was inspired by Roundhill, I think they were the first ones. I think the weekly strategy is actually helping the NAV because of the way the dividend payouts, they're lower. They're not holding them all like for the month. And they're also doing less of like overpaying. Early on in some of the early funds like OARK, Tesla, and some of those, there was some, possible overpaying out of the NAV, which accelerated the NAV erosion. Now that we're not seeing that and we're seeing more weekly payouts, I think the NAV is actually a lot more stable, which is great. If we can get a balance between stable NAV and a 20 to 40% dividend, I think it's phenomenal.
Monthly dividends versus like weekly income ETFs. Do you prefer monthly? Do you prefer weekly? Or do you really not care?
Yeah, seeing the results at this point, I think that I prefer the weekly.
So what are your honest thoughts on like WPay? Because you made a video about Ulti or YMAX like versus WPay. So do you
Right.
like WPay more than an Ulti and a YMAX? And like what are the reasons behind that comparison?
I like both, but I think WPay has definitely gotten something figured out in terms of the leveraged strategy with the 1.2x. So I'm always a fan of, whoever can come up with a better version of a product. And with the competition, the competition always breeds the best.
You've done investments in QYLD, I believe JEPQ and JEPI. We've seen newer ETFs come out with like enhanced versions of those, like QQQI by Neos, SPYI by Neos. So do you think that QYLD, JEPI, JEPQ are like old news, or do they belong in? Okay, so can you explain why?
I sold out of those. I had like a slight gain in the NAV, so I sold out of those. And yeah, I definitely think with the new ones you mentioned, like the GPIQ and stuff, like these QYLD, JEPQ, JEPI, of course. I mean, assets are flowing into the higher yields.
And why do you think that they're flowing to the higher yields?
It's almost like the same reason that the high yield space on YouTube is blowing up so fast. People want that income. They want that, passive income stream where it's like they're sleeping and they're earning money.
But why not just invest for growth? If you could just get the growth, I think you made a video on this on like invest for growth and then sell it long term at like the long term capital gains rate. You probably become more tax efficient, probably have better returns than going for the high yields and getting the different tax treatment.
I mean, you're preaching to the choir on that one. I'm 100%, I started as a growth investor. I still am. Long term, I always say that, and I get haters for saying that. I always say, like, go on Seeking Alpha, do a comparison chart. NVIDIA stock versus like NVDY or whatever, even in terms of total return, the underlying always outperforms. long term. I've actually never seen a case where the underlying doesn't outperform.
In terms of your thoughts on like cover call ETFs, who should invest in them? Like what type of investor? We've seen the craze this year of high income products become like the new wave and everybody wants to get a piece of the pie in their portfolio. But in your opinion, who should be buying these products?
I think mainly anyone looking for some like side income. It's tricky because, like Jay has said, you can't just take the income and set it and forget it. You have to, he says, manage your shares. The products attract a lot of recent retirees or people nearing retirement, people like on a fixed income that are just looking for $1,000 or $1,200 extra a month. In fact, in my one-on-one sessions, which I offer, I see many people that they say, hey, I just need X amount of income. Can I do this with your option strategy or high yield? Like, what do you recommend? The biggest audience that it attracts is really anyone looking for like stable fixed income. People are looking for like that guarantee. Guarantee, I'll say it in quotations, can be dangerous. Because when you get guarantees, you sacrifice a lot of potential upside. Risk taking, like they say, risk reward. Risk taking, some managed risk, I think is very important.
Let's say somebody's late to the game in their 50s, maybe early 60s, maybe even like late 40s, and they want to get into investing. I've seen people just go into the highest yielding products, but in your opinion, how should those investors be investing for retirement if they are late to the game?
I've actually seen a real life play out of this. So when I started learning options, a friend of mine that led one of the first courses I ever took, she was nearing retirement, actually. Single mom, didn't have anything really saved up. And she went to a financial advisor, one of the members of the professional investing class. And they told her, well, based on where you are, you might have to manage your expectations in retirement. And so she said, you know what? That's not cutting it for me. And she learned options. And by doing options successfully, she gained many years back that she had lost in terms of not starting early. A successful wheel strategy, successful option strategy could be the way to go.
Do you prefer dividend investing or growth investing, knowing that you've done both?
You had to ask me that. My portfolio, whether, Yield Max, Roundhill, any of the high yield stuff, I only ever did like maybe a 10% allocation to it. It was never like the big bulk of the portfolio. I'm still a growth investor. I'm a big believer, and like you mentioned, and I've said this in one of my videos, the long-term capital gains rate, when you hold a stock over a year, you're paying 15% versus your marginal income rates. So, which the more successful we are as investors, the higher that gets. But yeah, from a tax standpoint, from a total return standpoint, I'm a big fan of growth.
To build your portfolio to $1.2 million, what are some key takeaways that you've learned to achieve that? You look like a pretty young guy. Traits that you've done, or just traits that you have that have got you to that point?
I, like everyone else, actually started with zero. Like when I graduated college and stuff, like I had no money. So I had to start somewhere, and getting to your first 100,000 is the hardest part. Getting to your first million, even Warren Buffett said this, that's the hardest part. So it's really growth investing is what got me there. Maxing out my 401k, living way below my means, cutting a lot of stuff out. Like while I was in school and when I went back for a master's degree, I cut a lot of social stuff out, missed out on a lot of things, made sacrifices. But that's led to now where I'm in a position where I can pretty much do anything I want, travel anywhere, go do anything I want. And it's great.
Do you prefer lower yielding ETFs, like let's say anywhere between 10 to 15%, or do you prefer higher yielding ones, 60, 70, 80, 90, 100% yields?
I would say somewhere in the middle. And I've told Jay this a bunch. I've asked him, I said, hey, Jay, I think the perfect product, even though like they say, we're yield max, so yield max means highest yield. But I've always said like 20 to 30% is doable with stable NAV. Look at like a FEPB or like an AIPI, not to name drop, but even like curve funds, they're achieving a really significant yield. And a lot of their funds have a stable, if not appreciating NAV.
Your achievements. So you said that you got to 1.2 million through growth investing. So should investors who want to achieve that number, maybe at like a younger age, just be doing investing for growth, or should they be doing dividends, maybe hybrid investing, maybe just all into higher yielding products? What do you think?
It wasn't all the way to the 1.2 million with growth. I got to about probably 7 or 800,000. And then the rest came from the options trading. But yeah, I would say I got 70% of the way there through growth. So, and the way that worked, even if you have a 401k with an employer, you can pick their funds. They default most people to like a target date fund, which I say is crap. It's like a target date 2050, 2060 fund. And then a lot of times it will do like 8 or 10% in a year that the market's doing 30%. So luckily I figured that out when I was like 23. I looked at my returns and even before it was like the year was over, I was like, this is not keeping up with the market. I looked at like the S&P, the NASDAQ. I'm like, the market's having a great year. So I went and looked at the funds, and luckily, because I used to work for financial advisors, so I know all the ins and outs of the industry. I looked at the fund sheet because I think it was obviously JP Morgan funds when I worked there. Now I think we use BlackRock funds or something, but most of the fund management companies have the same palette of funds. So they'll have like a large cap fund, mega cap. They'll have like a tech fund. They'll have like a mid cap, small cap, S&P, NASDAQ 100 fund. So I picked all of those. I picked like NASDAQ 100, S&P, large cap, and then the 401k, it just took off from there. I was doing some years 20 up to 30%, even during COVID. I think the 2020 was like a 30% return year for me.
And for your 401k contributions, I'm assuming you did more than your employer like recommends, right?
Yeah, well, and that's another thing in life. Like, a lot of people are trying to follow a script. So, when they tell you, oh, do what your employer says, or your advisor tells you only do what they match. I actually did up to the legal maximum, the IRS legal maximum, which is like $23,000 a year. When I started, it was probably 18 or 19,000 a year, but it's gone up consistently. Like in my early 20s, I did what the employer match was, but then I started going higher and doing what the legal maximum was, because as I got higher salaries, I didn't want to pay as much in taxes. So I put all of it into the traditional 401k IRA, and then it reduced my taxable income. Now it doesn't matter, because with trading and all that, it's like I'm kind of screwed either way,
When you hear the term NAV erosion in the cover call ETF space, what are your honest thoughts on that term? And should investors be afraid of any ETF when they see massive NAV erosion, or just be afraid of that term of NAV erosion?
Well, the term itself, it's not actually, I think, a correct term. I think Mike from YieldMax, Mike Venuto, he called it relative beta decline or something. It's obviously the decline in the share price over time. And sometimes it exceeds what the dividends are paying out. I think if you see that sustained over time, it's definitely a concern. Like if it drops like 20%, that's a signal, at least for me. I usually try to get out of those. If it's temporary, like if there's a little bit of a downturn, like what we saw in March and April, that's just cyclical, temporary, and then it recovers. But if it's like a sustained drop, then yeah, absolutely get out of it. For me, anyway.
The sustained drops, in my opinion, are from those funds that are over distributing, overpaying, investors, which are unfortunately like those super high yielding products. So should investors avoid those ETFs in general?
As an investor, you have to make that choice. When I got into Tesla in 2023, what enticed me was the fact that for about a month or so, I tracked the chart, and it followed almost identically with the performance of Tesla. And so I thought, wow, if this can pay 90% and track with Tesla, that's amazing. But obviously it didn't last. It led to a reverse split a year later. And for those, like for me, I'm still in all of those. I've actually never sold any of the YieldMax funds because I put no more than, the 10% portfolio allocation. And so they still pay dividends. And so I'll just ride them out. I don't think a fund like Tesla will ever go bankrupt as long as the underlying keeps going up. But what was discouraging for me was last November when the market just shot up. Tesla hit all-time highs. During that time, Tesla went up as well, but didn't come anywhere near its pre-split high. And Tesla also recently matched its all-time high, or it came very close to it. And Tesla, while it does go up, because it's that covered call strategy, it's capped. So there's debate on whether or not it can ever fully get back to the price that original investors actually bought in for. But for me, I'm just still holding the bag on it.
Reverse splits. Give me your thoughts on, that term of reverse splits, because some higher income products might see it, and the ones that are lower distributing yields will, hopefully not see a reverse split because they're like in a 10 to 12% range versus the other higher yielding ones.
Well, YieldMax only did it once on Tesla. I think it was so unpopular that I think Jay actually said with MRNY, they're just going to let it go down to like $1 or so before they do it. And it's almost there. I mean, you see it's dropped significantly, but reverse splits, you lose shares, obviously. And I could show you my original Tesla position from the reverse split. I lost some off the top, like it was just gone, because it's not like an even like 2-for-1. When you have an uneven number, like they sell those off. When you go into your actual detailed cost basis, like I'm a big believer in keeping track of all your own stuff in a very detailed way. That's how I got to where I am. You have to go into the minutia of all the cost basis and all that. And it's very time consuming. Keeping track of every investment you've held, very time consuming. But you'll find that when you look at what your broker says versus what you tracked in your own spreadsheet, you're like, wow, that position, I've actually lost more in that than I realized. So that's what I noticed with the reverse split from Tesla.
So should investors go all in cover call ETFs, or should they have growth if they want to get like the best returns possible in the market?
Well, not that I'm one to ever give advice. I mean, everything I say is just entertainment, but I would lean towards no, on going all in on a covered call ETF strategy. Definitely say no.
But you like it as like a complement, maybe
Yeah.
like a lower, what kind of percentage allocation to a portfolio if somebody wants income, but also they want growth as well?
Like 10 to 15%. So I'm a big fan of having like multiple income streams. Like right now, I think I did a video, I have like 8 income streams now. And my full-time job is one piece of that. So the goal for years, I know I'm going to kind of go on a rant here, but the goal for years was to just replace my work income. Now I've done that 3 or 4 times over. So like I have my work income, I still have a full-time dividend income, basically. If you consider median US income legit full-time income, I have that. I have the options, the trade wins. And then I also have, I don't know if you saw my video on the Fidelity money market rates, but my money that's all tied up in options premium, get like another 50,000 from that. If I buy these dividend funds, it's another stream of income. So why not? If I have this, I'm making this money over here, I'm protected over here. It's like having multiple jobs without actually working.
What are some common mistakes that you made along your journey that you hope to always avoid and tell people to always avoid?
Early on, I think I listened to too many different opinions. And as an investor, well, the more experience you get with whatever field you're in, you develop like a natural instinct. I call it, you'll hear the different voices in your head, but you got to listen to the right ones. Like I have, my family that didn't really understand investing outside of like whatever their employer, like my dad was a blue collar guy. They never got to this level of investing, and they'll look at it. They've been through crashes in their lifetimes, especially, even like grandparents, they went through like the Great Depression and all of that. So people that have lived through crashes like that, they'll tell you, oh, investing's risky, be careful and all that. Well, yes, risk is one thing, but managed risk is another. So I think that I was too cautious early on. When I would buy stocks, I would be like, oh, I'm at a gain, sell. I would sell too fast to lock in a gain. It's almost like I was afraid, of any drops at all. And I've found when I go back and look at all the positions I've sold, if I held pretty much every position longer, it would have gone even higher.
What are some common mistakes that you see dividend investors make that are beginners, and also growth investors make as beginners?
Dividend investors as beginners, I see they get, I think I call it irrational exuberance. They get too excited too quick. They go too far. And you see some channels on here talk about home equity loans to use to invest in dividends, or going all out on margin. I see a lot of people, even with growth, it's kind of similar with both. They may go all out in margin without fully understanding what they're doing. And margin works great. When you know what you're doing. Like I watch Todd's videos, he manages margin very well. But if you don't know what you're doing, margin can be very dangerous. You get margin called, all of a sudden, you're impacting your financial future. Yeah, with dividends, I think there's a lot of irrational exuberance. I feel like growth is harder to screw up, but I do see some of the same things, some like very quick risk taking or more risk taking than someone should take on, like borrowing money to invest. I see that happen with both.
Would you rather use margin to invest on your own for dividends or growth, or just buy those leverage ETFs, or leverage ETFs to also have income as well?
I started out like not using margin. Like I was a big believer in like, just do it with your own money. But margin can be a great strategic vehicle, especially like when you're trading options, you're not actually paying margin interest while the trade is pending. Unless you get assigned. And a lot of times, like we can negotiate margin rates with the brokers, so we can get a much lower margin rate or move accounts to a place like, Robinhood or even Interactive Brokers, which has the lowest margin rate in the industry.
As a more experienced investor yourself, are you nervous at all ever of a stock market crash or a recession? And how you're nervous. And so how would you react though in a market recession or a stock market crash?
I get nervous, but I call it managed nerves. So the more experience you get investing, like I say, you develop a natural instinct and you develop really thick spine, I guess to put it mildly. March and April were very stressful months. I probably lost some hair in those months. I mean, it was very stressful with the tariffs and all of that. But weathering that, on the flip side of that, it's been amazing. So like there's a quote, on the other side of fear, you often find you're surprised what you find on the other side of fear, in terms of like a good result. After June, we're kind of on the other side of that. Now, at some point, laws of physics apply, right? What goes up must come down. As long as the Fed keeps cutting rates, I see the market continuing to go up. But at some point, things will correct. And when that happens, I'll have to decide, on my option strategy, do I keep selling out? Do I keep selling higher? Or do I pull back? The one thing I've got to make sure I do is actually take gains. So like take like 10% gains, from the account.
Investing to achieve a long-term sustainable dividend snowball.
So I started that with stocks like Philip Morris, AT&T, Verizon, and all of that. With stable dividends, that snowball effect can work incredibly well. If you just keep reinvesting those dividends and set it and forget it, have those positions on drip, basically. You're going to snowball pretty substantially over 10 to 15 years.
Do you have a retirement age in mind? And how much money do you want to have in your portfolio and to also have in dividends if you want that as well?
So every time someone asks me when I want to retire, my answer is always as soon as possible. It could even be next year. It could be 6 months. It could be the next time I get a 401k match at my company. And then after that, I just say, see ya. So it's coming very soon. It's definitely going to be a lot sooner for me than it is for most people.
When you hear the term diversification, what kind of portfolio do you think is a properly diversified portfolio?
Studying finance, I've studied portfolio management and all of that. And I actually agree with Warren Buffett. Warren Buffett says diversification is BS. Now, that being said, I also agree with the quote, don't put all your eggs in one basket. So, but if you're picking great companies, again, it's managed risk. If you're like Warren Buffett says, I don't even look at the price of a stock. I pick great companies that I know 10, 15, 20 years from now are going to be much higher than they are today. But as far as perfectly diversified, I think as long as you basically own the indexes, S&P, NASDAQ, some large cap, small cap. Yeah, it's pretty much all equities and maybe some international, like emerging markets. But yeah, that would be my idea. NASDAQ, S&P, heavily US based with maybe some exposure to international.
How should younger investors be investing in the market for success versus people who are older in their investing journey?
Well, you've got two completely different time horizons. So when you're younger, you can take on like maximum risk because you have your whole life to recover that. When you're older, you can also take strategic risk, but it depends when you're going to retire. Like if you're going to work, if the economy crashed tomorrow and you were wanting to retire next year, you may have to prolong that a little bit. The retirees in '08 that were looking to retire the next year, if they worked for like 2 or 3 more years, they pretty much recovered everything that they lost. And then if they worked until 7 or 8 years later, they were way ahead of where they were originally. Yeah, it would be different for the 2 time horizons, but I think you can also take on risk as an older investor too.
When you were building your portfolio and your net worth, did you have like a lot of debt from going to school? I think you got your MBA as well. And like, how did you tackle on, investing and paying bills and life expenses, emergencies, and,
Right.
because you're a big finance guy, I'm sure you had a budget and all
hmm
this type of stuff as well.
Yeah, well, I was living really cheap. So for one thing, I got my work to pay for my master's degrees. And I pretty much I had like in-state tuition and scholarships for my undergrad. So I had minimal debt. And then my expenses were really low at the time. Cause like in Florida, Florida's a pretty low cost state. And yeah, I just really was able to live like well below my means for a number of years. Didn't, like I said, early on, like my early 20s, I lived very frugally. Didn't travel nearly as much as I do now. Didn't do like as many things. Still had fun, but kind of, really kept a lid on it.
Did your parents ever teach you about like investing and like having proper like financial, I guess, literacy?
Well, so my dad and my mom were opposite when it came to money. Like my dad was pretty good with money. My mom wasn't, but my dad was very frugal. And even though like we did well, like, middle class household, he still kind of made us feel poor in a way. And so that taught me to appreciate money. He never got to the level of sophistication as an investor. He just did 401k and stuff like that, but he did very well for himself for like how he came up and where he ended up. He actually did very well. So I got some of that, from him. And I guess my grandpa, my uncle, they kind of had a knack for being good with money.
Do you have like a way of investing your money in terms of by timing? So do you max out the 401k first and then the Roth IRA, and then you put whatever's left into the taxable account? Do you have like a certain timetable of where the money goes into each account first to maximize, taxes and whatnot?
Sure. Yeah. So the 401k, I just have that withheld from my paycheck until it hits the legal maximum. So like around December, the last 2 paychecks of the year will be bigger because it hits that typically by like November or so. I think I withhold like 25% or so, for that. And then the Roth IRA, I just do that entire contribution at the beginning of the year. Same with the HSA. I just max those out pretty much immediately, first month of the year.
You said that you did, Philip Morris, AT&T, large dividend companies that have lower dividend yields, but now we have, cover call ETFs. We have SPYI, QQQI by Neos. We have the Yield Maxes of the world, Roundhill, Curve, all these different issuers that have higher yields than traditional dividend stocks. Do you think that investors are moving from traditional dividend investing, from individual stock picking, maybe even in like a SCHD, to these cover call products? And why do you think that is?
I think so. SCHD is one of the most popular funds, and given its yield, I never quite got it as to why it's as popular as it is, but that's cool, for whoever likes it. As people see higher yields, they're going to go for higher yields, stable higher yields. I mean, if you're only earning, like if AT&T was paying 6% and the stock dropped, or SCHD paying like 3.9%, you can get that with like a money market or a CD. Why not go higher, get a higher rate of return? I think that's what most investors are thinking. And one thing too, like with AT&T and Verizon, those were stocks that for years never dropped. Then all of a sudden they started dropping. So that really left investors kind of holding the bag.
On a scale from 1 to 5, 1 being the lowest amount of risk, and then 5 being the highest amount of risk, what kind of risk do you think that your investing strategy and portfolios are combined?
Oh, my risk is very close to the high end, I would say. I'm pretty much maxed out on the risk.
And you like that? You're comfortable with that?
Yeah, I mean, it has its moments, like March and April, particularly. Again, I'm a more experienced investor than the average person, so I can take on more risk.
Being experienced, how did you learn about investing and like your current strategy? Because options and the everything that you do in your portfolio is a lot for beginner level investors. So how did you learn to invest the way you do, and how could beginners learn as well?
Well, I just started, dabbling in the stock market. Of course, Studying the subject helped a lot. Like in my master's program, I had a lot of options exposure, but at the time I wasn't applying it. I more so learned what I needed to pass the test. But until I actually started seeing other people doing it, seeing YouTube videos and stuff like that, I was like, wow, this actually can make you a lot of money. So that was, education, practice, and then actually seeing other people do it was what got me to become so experienced. Funny enough, I was never good at math, as a kid, but then when I started applying it to money, it clicked. It was like, oh wow, I can actually make money with this. And then I got good at math all of a sudden.
What's your thoughts on DRIP? So some investors automatically reinvest the income or dividends from covered call ETFs or just dividend ETFs. And then some of them, they take half of it, spend it, or they take half of it, put it back into the fund, and then maybe some portion of it into another ETF that they feel more conviction on.
Me personally, I turned off DRIP. But what I do personally doesn't necessarily apply for most people. So DRIP, I think if you want to get that dividend snowball, and you want to kind of set it and forget it, I think DRIP is great. I think you can certainly just reinvest all your dividends or half of them and then do kind of like the dividend wheel, like you were describing.
What do you look for if you were to choose a cover call ETF? Is it yield? Is it the underlying holding or holdings, the strategy, the ETF issuer, the total returns, or is it something else?
I would say all of the above. Total return is very important. The underlying stock is very important. The volatility, the NAV, yeah, all of that is important.
What do you like more? Is it lump summing or dollar cost averaging, and why?
Dollar cost averaging, because like I've seen in my 401k over the years, the dollar cost averaging works brilliantly because when you're down, you're buying cheaper, you're buying higher too, but it's like a mitigating strategy. You're averaging, so your cost of ownership is leveling out over time.
As you age into, just age as a normal person, are you going to be more of a dividend focused investor? Because some people do growth for like 10, 20, 30 years, and then they flip it to income focused investing. But are you going to just be sticking to mainly a growth strategy for, I guess, the foreseeable future?
Most likely, I'm going to be doing this wheel strategy as long as it keeps making money. But I'll keep an allocation for I'll have a stable dividend portfolio that no matter what will pay me an income. That way it's there to fall back on. It'll always be there.
What do you think is a common misconception or a mistake people have in their mind? Mainly, let's say like growth investors or maybe lower yielding dividend focused investors, high yield cover call ETF investing.
That they're always going to stay the same or go up. And I think early on, I even made little short videos that were some of my best performing videos where I showed, wow, if you have a 90% return compounded annually, you're going to be a millionaire in 10 years. So I think thinking that, that's going to stay constant and always keep going up, that's the biggest misconception that I see.
Non-financial advice, we're not financial advisors.
Right.
Do your own research. Investing is high risk.
Mm-hmm.
But what are some tips you have for beginner level investors or newer investors to the market that are watching this video, watching your channel, and just want to build a long-term strategy for their investing needs?
Biggest message I can give for anyone that's brand new to investing, I was once in your shoes. You can absolutely get to where I am. You could probably get to where I am even faster than I did. You just got to want to, and you got to be driven and be focused and stick to a strategy.
Any last words? Something I might have missed?
No, that's pretty much it. Just, best of luck investing to everyone. Glad to be on here. Glad to collaborate with you. Look forward to having you on, my channel. And, hopefully, we'll keep this space growing on YouTube.
Thank you so much to Thomas Bell from Live Off of Dividends and Options now on YouTube, aka The Coach. Now you guys can go check out his YouTube channel right now in the link in the description of this video, as well as you'll see it on your screen. Now, once again, guys, please give this video a like because this Q puppy did. Thank you so much for watching. And once again, this is not financial advice. Do your own research. Investing is risky once again. And check out our last video on your screen. I love you guys so much. Crush on the stock market and take it easy. Peace.
Thanks, everyone.